Joining us right now to talk about how global tensions are impacting energy and much more is U.S. Energy Secretary Jennifer Granholm. And Secretary Granholm, thanks for being here today.
You bet. Thanks for having me.
Let's jump right in and talk about what's happening in the Red Sea and the surrounding areas. Mike Wirth talking about not only the Red Sea, but these attacks in the Straits of Hormuz from the Iranian Navy. What does this mean? What can we do to try and ensure safety of shipments?
Yeah, this is an issue that's been certainly top of mind for the administration. In fact, we've put together a coalition of more than 20 countries that are countering these attacks and really protecting international commerce, focused on that through an effort now called Operation Prosperity Guardian. That's the title of it. The U.S. issued new sanctions last week on individuals and entities that are facilitating these attacks. And we're going to obviously continue to be very much on this. But with respect to how we're seeing it play out in the energy space, is that so far the ongoing conflict and attacks, which are, indiscriminate. They're on any commercial vessel that's coming through, whether it's touching or related to Israel or not. But this conflict, they have not really been successful in terms of getting their targets, but this conflict itself has really only had a limited impact on energy prices. For us in the U.S., the gas prices, for example, are at $3.09 today, 3.089, something like that, more than $1.93 lower than the peak after Putin's war. 30 states, the average is less than $3 a gallon. So we aren't seeing the price per barrel or the impact at the pump. But obviously, the United States is on it and is leading this coalition to protect those commercial shippers.
Yeah, honestly, WTI at $73 a barrel probably doesn't reflect a lot of these renewed concerns. The news, the very latest from Maersk this morning, saying that they're going to be diverting vessels from the Red Sea for the foreseeable future. They just say that it's a highly volatile situation and that there's a big security risk here. We have seen these types of actions in the past. What will it take to actually ensure that ships can go through that area? How complicated?
Well, obviously, yeah, there has to be this coalition effort. I know that many commercial shippers are really not just, they're doing what Maersk has decided to do, which is to circumvent the Red Sea and the Suez Canal. And that may add some price to energy in terms of how long it takes and how much more fuel it takes to get those shipments around. But this coalition and the active, not just monitoring, but insertion of both sanctions as well as lots of discussions behind the scenes. I think we're going to, hopefully, if it doesn't escalate further, we'll be okay, even if there has to be a wholesale diversion of shipments around the Red Sea.
Secretary, we've talked a lot about what's been happening with ExxonMobil and Chevron as well, walking away from basically the refinery situations, their operations in California. They've taken massive write-downs in the last several days to the tune of billions of dollars. Mike Wirth was on talking about this last night and mentioned that the situation in California is largely because of California policy. I realize that's not a federal policy, but when you look at California and the gas prices there, it creates unhappiness with the consumers. They've basically said, we can't continue to make investments in some of these operations, whether that be the refineries or the pipelines, because we don't think we'll get the return on investment. When they say something like that and you have multiple big companies basically walking away from some of these things, what does that mean? What can you do on the federal level?
Well, it's interesting because I think there's a lot of those who have refineries who are converting some refineries anyway to biofuels. There is significant policy incentives to the creation of drop-in biofuels. So you're seeing some of that happening. The refineries that are around the country are working full tilt and are producing. So I will say this, Becky, we are seeing in the United States that we think that we have achieved peak gasoline because of the increase in electric vehicle sales. And obviously this is just the U.S. Other more developing countries are still looking at, significant, potentially significant, but lessening so increase in demand. But in the United States, we're seeing a leveling out and a diminishment of the demand for gasoline. And, we just got the numbers yesterday for the sales of electric vehicles. I know you had a segment earlier about this, but in 2023, 1.4 million sales of EVs. That's a 50% increase from the year before. That's going to have an impact.
Fleet, though. It's still an incredibly small part of the fleet in the United States. But
10%.
What I will say is to see some of these policies embraced in California where they say we want to be at peak gasoline usage, and as a result, we're going to make more and more strict laws that require all of these other things that make it less and less likely for companies to want to invest in the refineries there. I mean, what you've seen is gas prices are much higher there than anywhere else in the nation, or with the exception of potentially Hawaii and Alaska. But what you see are these California prices that are significantly higher. If you see that carried out throughout the rest of the country, you will probably have a very unhappy electorate because every time they see gasoline prices up $1, they scream.
Of course. And I don't think you're going to see California taxes or prices carried out through the rest of the country because these are all done, as you say, on a state-by-state basis. California is unique.
But they're talking about the same things that you just talked about with biodiesel and other issues. If you spread those on a national level, you will have probably similar reactions.
Well, but a lot of the increase, a lot of the price gap for California, the significantly more expensive price per gallon does have to do with gasoline taxes too. So, I think, everybody knows, Becky, we are in this transition right now. It is for consumers significantly less expensive to operate an electric vehicle than an internal combustion engine vehicle.
Incentives.
With tax incentives,
with tax incentives that taxpayers pay for. In mass.
There's federal tax credits that they benefit from if they are able to take it up, and if they're able to afford a lease, and a lease, of course, is cheaper than perhaps a monthly payment for a purchase. And these tax credits, $7,500 off of a lease, you can really have an affordable vehicle. It's much cheaper for somebody to operate that. So, we're in this transition. It is not going to always be smooth and easy, but on the other side of this transition, I think that people will come to love as people who drive electric vehicles have. 95%, according to the J.D. Power survey, have extremely happy with their electric vehicles because of cost and because they're fun to drive. I think you're going to see this transition continue to increase. I mean, it is at about 10% of the fleet right now, but that is going to continue to increase at the same sort of pace that we've been seeing it increase.